Welcome back, everyone. Welcome to another episode of Wide World of Options here at the OIC conference. With me today is Kevin Davitt. If you are a fan of tech stocks, you likely already know Kevin's name. He's the head of index options content at Nasdaq. If you're not familiar with Kevin, you're in for a treat, because not only is he one of the more prolific and interesting educators in the industry, but he's also a pretty interesting guy. He's a fellow lover of live music, and equally as important, he's a member of OIC's Roundtable Advisory Group. So, Kevin, I know you've got a busy schedule here at conference. Really appreciate you taking the time to join us today.
Thank you for having me, and let's not downplay how busy your schedule has been. You just finished, I think, one of the more engaging panels of the conference, so thank you for this opportunity and that.
Kevin, thank you for that. I appreciate it. Let's go ahead and start with volatility. It's a buzzword that it's the same thing we're talking about this year, same as we talked about last year, year before, and likely the next. When it comes to these volatile markets, a lot of investors see it as an opportunity. Other investors to see it as something to stay away from. So in your opinion, is volatility good for investors or bad? Let's start with that.
Okay. I love the way you frame this conversation. The reason that at conferences like this it will remain a buzzword is because overall volatility and idiosyncratic stock volatility is embedded in the price of options throughout time, and that will always be the case. So an understanding is key. You drew a distinction that I think is fully understandable to the broad investing public, but I want to hopefully, and I don't love this term, but tease it out a little bit. So in my mind, volatility is one of those terms where the connotation, what people typically associate with it, is often distinct in some meaningful ways from what the term itself, the denotation, the definition of the word. So what I mean there is that most investors, passive long investors, associate volatility exclusively with downside moves. Mm-hmm. Now, I don't think that many people would look at a session like we saw right around a month ago, April 9th, where the Nasdaq 100 closed higher by like 12%. It was like the third biggest up day ever for the index, as a volatile day, but it most certainly is.
Right.
So it's just volatility that they tend to associate with the painful part of capital markets. And then there is the other sort of side of the coin where those who are more option forward and sophisticated understand that there are ways to use options to embrace that or to offset that potential risk. It's my long-winded way of saying volatility is a constant, but the degree of vol will ebb and flow, just like we've seen over the course of the past month. We went from one of the highest levels of realized and implied volatility in 5 years to now 10-day realized volatility in the broad market as measured by the Nasdaq 100 is near the lows of the year. Mm-hmm. So it's a constant, but it ebbs and flows. Volatility is also non-directional or bidirectional, if you want to think about that. And it's important that to understand that concept with the flexibility that's embedded in options. Now, if you're exclusively focused on calls for example, and owning them, you are looking for upside volatility. And the flip side is true if you are focused on puts and long them. You want downside volatility. But if you own optionality, then you're long volatility. And there's a whole lot of nuance beyond that. But generally speaking, people that embrace and understand optionality understand the inherent role that volatility plays in their exposures. So one of the points you alluded to is, are there ways to embrace volatility more openly? And I think one of the best ways, first of all, and I'm sure you've said this on previous recordings, but we don't give advice. You know that full well at OCC. But what we can do is, I think, provoke thoughtful inward conversations where people are forced to ask, well, where is my risk really? And starting at that point, I think can be really instructive as to how you might be able to incorporate option strategies that don't augment that risk, but offset it. And that's stuff that you talk about in webinars regularly, and that I try to educate those new and relatively new to the options on often. It reminds me, and something, a point you brought up in the panel at the conference, it reminds me of the days of managing risk in a professional capacity. And you would get sheets every morning that showed you things like P&L from the previous day, expenses, and arguably most important was the risk that you had in front of you to manage that day and going forward. Mm-hmm. And I think that's what we're talking about when we think about individuals, like what risk do I have in the market right now and how best to manage that? And it would show you based on underlying up or down 3% or 5% or volatility up 10% or down 10%, what your P&L looked like. And I think the more the investing public, particularly those that embrace optionality, thinks in those terms and lets that inform the type of strategy that they might employ, the more they're able to embrace and understand volatility and not be off-put by it, and really allow themselves to rid themselves of that connotation that we have with volatility and just say this is a reality and it will be through time, and there are things that I can do proactively to mitigate those swells of volatility.
Right, so it doesn't necessarily have to be the boogeyman that new investors think it is. It's, as you had mentioned, it's just inherent to options industry. It is as it is.
Correct, and I know that's a little sort of vague and amorphous, but it will continue to be. It is a constant, but you do not necessarily need to be a victim to it. You can sort of embrace the rudders and steer with more precision when you really understand how that volatility is embedded and expressed in the price of options, something the OIC does a great job of explaining.
Well, thank you. So volatility certainly is a trending topic, but as you know, we both mentioned, it's always a trending topic. So is a trend if it is always existing? But building on that, here's another question for you. What else is trending? What are some other trends in the industry today that you think is going to shape trading for tomorrow, let's say?
All right, so I really like that question, and I imagine you've probably asked it to other people that
and I've already got the answer in my head. I'm wondering if.
Oh man, I don't think there's one answer.
No, there's certainly not one.
I'd love to know your take, but I love that question because there are so many different takes, and that's clear when you sit down at a conference like this and hear different takes about what might transpire over the next year or so until we're back here again. I think you and I probably look at this fairly similarly because of the roles we're in. The focus on education and the potential benefits as well as the risks associated with individual stock options, ETF options, and index options. So my take on that, in the past couple of years, there's been way more attention paid on the value and the importance of education and how that lays the appropriate firm foundation for growing, protecting, and growing capital through time. And I think that would continue. I've worked, and you've worked as well, in the options education kind of business more broadly for a long, long time. And I think about, we're talking about trend shifts, how the demographics have changed so meaningfully.
Right.
And this is something that has occurred just over the past couple of years. No knock on the way things used to look, but when we would go to events years ago, it would be a bunch of guys that look kind of like us.
Right.
And
Sadly.
Almost overwhelmingly guys and up there in age.
Yeah.
And when you host events, when we host events, it looks dramatically different these days, and I find that so exciting. The people, we touched on this in the conference, but the options user is skewing significantly younger. We are seeing way more women attracted to these markets, and I think that's a great thing. Research shows that they tend to be better at managing risk writ large, so bring it on. And I think we see a whole lot of college students, and even in some cases younger, embracing and really understanding options. That is one of the biggest trends. Another, I think, meaningful trend, and something I'm sure you've talked about, is the proliferation, the growth of short-dated options trading. And I don't want to belabor that, especially if you've paid a lot of attention to it already. I think you and guys like Matt Cashman, your colleague, do an amazing job on educating the public on the slightly unique risks and potential rewards associated with those near to expiry options. And then what else would I talk about? Is the last thing that comes to mind for me is the wrapping of optionality in an ETF wrapper. And the reason I think that is so meaningful is because there's a huge swath of the public that doesn't want to manage the nuance or really get into the weeds with optionality, but they want the potential benefits embedded in these structures. And by and large, what many of these products are doing is making that, and I'm thinking primarily about defined outcome type structures, is making those benefits where I can define the amount of downside that I'm going to expose my portfolio to over a finite amount of time, as well as a potential cap, and people are very willing to make those trade-offs. You see that sort of evolution in consumer markets across the board. Like, you can customize shoes these days and everything. And so I think we are seeing that play out in our business, and it's so exciting. And I'm excited to listen to the other recordings you do to get that take, to get the different takes.
Yeah, so I think you hit on a lot of points that that others agreed with. Certainly, the younger demographic. You had mentioned, college students and even younger. My colleague Romo Caldwell, who I'm sure you know, does a terrific program with University Outreach. The rise of zero DTE, a big one as well. Matt Cashman, you had mentioned. I know Matt does some terrific presentations on zero DTE. So those are, definitely some of the things that people had talked about. One thing that I thought was interesting, I just sat on an education panel, and Jamal Chandler from Tasty Live was on. And one of the interesting things that he had said was that he doesn't know what the next trend is going to be. That we didn't realize the rise of AI and the role that it would play with options trading, and we're still in its infancy. We're still kind of ignorant, or maybe uneducated, or maybe unimaginative of where that might take us. But his point was that with everything changing in the world, so often as it does, that we don't really know what that next big trend is going to be because it hasn't even been invented yet.
Isn't that, I'm a huge Jamal fan. I worked with him years ago, and I was so excited to see him this week. But isn't that kind of candor really welcome?
I loved it.
And honest. People, you can get headlines saying, I think, I feel really strongly that we're headed this way or that way. But the fact of the matter is that, like we heard in the keynote, these are new tools. But it's humans that shape outcomes given these new tools.
Yeah.
And that, again, when we talk about volatility through time, has been the case through time. And I love people that are able to relate stories and explain these complex changes. And how that's been the case, let's bring David Byrne into this, same as it ever was.
I love it. Really, what is, who's more volatile than the human species?
Exactly.
Yeah.
Yep.
Yes, and you're absolutely right. The AI presentation, the point that he made wasn't necessarily the importance of the capability of AI. It's more the importance of the human using AI and how they're going to use it and how they structure it and et cetera. I thought that was an interesting point too.
Change is scary. Change is scary. And I think that narrative runs parallel to the growth that we've seen with options. And I don't think I'm really extrapolating too much here, but you can, as an investor, marginalize the relative impact of change in the market that it has on your portfolio or my portfolio by understanding and employing these tools. And it's very similar when you talk about these big, broader, potentially scary ideas like AI. And it is, the change occurs through the lens and with the influence of humans, and that reality was reassuring.
Yeah, it was very interesting, very eye-opening for me. When it comes to change, it brings opportunities. It also brings challenges. So looking at the future of trading, what are some of these key opportunities or challenges that you see specifically for retail investors with today's market environment?
One of the more thought-provoking, interesting elements that I picked up on today was how readily retail, or I prefer to refer to it as individual investors.
I do as well.
I think there's something pejorative about retail. I don't know what that is, but I think it's dated in.
I think it minimizes the importance of the investor.
And the role that individuals play in capital markets, across equities, across options, futures, is larger, continues to grow. I think that's going to continue. But your question was, what sort of changes are being embraced now? And I'm going to combine this with another one, or another one of the ideas that we've talked about, which is how can we become better at these things? And the way I look at that is that we become more systematic. And I heard about how individual investors are armed with tools and APIs where they can use systematic strategies, where they can backtest performance, and they can remove the potential, or much of the potential human element of it.
The emotion.
Yeah, exactly.
Right.
And use these tools to place trades and to manage risk based on their parameters. And that, I think, is a super powerful evolution. There was something yesterday, our industry colleague and friend, Henry Schwartz, talked about specific points during the day where there's spikes in activity and that it's likely tethered in some way to this type of trading.
Was that mind-blowing to you?
Right.
I guess I never thought about it because there were other people I were talking to about that concept, and some of them were like, well, yeah, it just kind of makes sense. Where others were, boy, that was so eye-opening. I was in the latter category.
Well, I think we've been aware of things like VWAPing into bigger orders or TWAPing, stuff like that, which has gone on the institutional side for forever. And that makes sense because you don't want to jump right, especially with meaningful big orders. You can chop it up and get it done through time. But for individuals to be able to really eliminate huge components like emotions get in the way of rational decision making, and discipline, that type of discipline is really hard to instill, especially during times like we just saw. But thoughtfully employing the tools that are available increasingly to everyone as a way to, again, protect and grow capital through time is something that I'll embrace, and it's going to be one of the big takeaways from my time here this week.
Yeah, so removing that emotion, do you think that leads to somebody becoming a successful trader, or at least putting them on the right path to trade successfully, removing that emotion?
I would say it becomes much more likely. We talk about probabilistic thinking.
Yeah.
And I think when you are employing strategies based on probabilistic thinking as opposed to I know how frustrated I can get in everyday life. And then let's say you just have, because we are humans, and you're having a bad day to begin with, and then you look at a day where the market moves 2% against you and a bad P. Like, I am far less likely to make a really shrewd investment decision then. And if I can put up some hurdles, right? We've been really intent on reducing hurdles, but we can use technology as kind of a hurdle or a barrier for making bad decisions. I welcome that.
Yeah. Yeah, I like that. I was talking with Tony Zhang yesterday, and one of the, actually to me, the most important takeaway I got from our conversation is that traders spend too much time on their losers and not enough time on their winners. They worry too much about, they are down 50% on their long option, and rather than just, maybe getting out of that trade and doing something else, they try to worry about how to manage that position rather than taking their winning trades and try to make those even greater winners, trying to maximize that profit. So to me, I thought it was a terrific takeaway. I know you're a golf fan, and it kind of reminded me of the of the amateur golfer that spends all day on the driving range, trying to bang out, 300-yard, drives off the tee box and can't putt for, their life. So it kind of reminded me about something like that of you're focusing on the things that are less important and not putting enough emphasis on those things that are more important.
Let's run with that golf analogy, and we both know how many shots in a round of golf are generally right around the green, and what separates a high handicapper like myself and perhaps you, I don't know, I don't want to project.
I sure am, yes.
And low handicap, very good golfers,
Yeah.
is that they're not taking as many shots around the green as you or I likely would. Now, I'm going to extrapolate that in a way that I can't help but doing, given the seat that I'm in. I think about the growth of indexing and of passively tracking benchmarks over the course of the past couple of decades, right? That's not new. But what is it about, because we know, or most people know, that over long time frames, markets generally tend to move higher, right?
Right.
That is the case, but how do we reconcile that with the fact that over a long time frame, something like 80 to 85% of equities go like the dodo bird? Well, what's happening is that people are increasingly indexing, and indexes are systematic, and they add to winners and they get rid of losers on a systematic way, like with quarterly rebalances.
Oh, yeah.
And
like
systematic year end, they clear it out, and it's done systematically. And that approach over long time frames works well. And I think the more we're able to do that on discrete individual positions, the better off you'll likely be. That said, it remains very difficult, very difficult. And for people, one of the other points you made up on stage today that I think was meaningful is that there's a lot of attention paid. The way that some people are introduced to our markets is through sensational, social media-driven narratives. And what can capture attention is likely not behavior that will be rewarded in the long run. And so having groups like the OIC and hopefully some of what I do to be a slightly sober look at that and point out that this is difficult but not impossible when you understand the tools that you're working with and you have a real plan and you remain disciplined, that leads to, again, better positive expectancy and better long-term outcomes.
Right, and better experiences for traders, which is something that we all hope for in the industry.
Amen.
Yeah, amen for sure. Kevin, thank you so much. I really appreciate you stopping by. Always great to see you, always great to talk with you.
Thank you. I feel the very same way, and I appreciate this opportunity.